These series of videos are demonstrating how to automate economic policy through code. A link to the GitHub repository is included in the video description. In the previous video, definitions were offered which you can probably do without, unless you have some cult-like opinions on how an economy behaves. The short of it is, everyone is entitled to live in a free market. In this video, we're describing the problem everyone faces with the current market. 1. Chartering banks to United States Code, Title 12, Chapter 17, Section 1841C. We can look it up. Navigate to uscode.house.gov. Scroll to Title 12, then Chapter 17, and Section 1841. Now go down to C. Bank defined. The important words here are deposits, payment, and loans. Once again, deposits, payment, and loans. The problem with bundling the services of deposits and payment with loans is that it allows the uncompetitive acquisition of capital. No one who has a technical comprehension of finance would have ever allowed this definition in the law, because it means this firm can acquire capital for its loans by merely storing and moving money for people. This is absurd. That's no different than someone opening a pizza shop and offering people the additional services of storing and moving their money, but then telling them, hey, when you're not using your money, I'm going to use it to buy flour, eggs, and pay rent. And so now pizza shop owners are acquiring capital for reasons that have nothing to do with selling pizzas. Venture funding aside, the only reason why a lending company should be offered capital, and that's what banks are, they're lending companies, is because after measuring their revenue and expenses from lending, someone wishes to invest in their loan portfolio. So to drive this point home, if you're standing in front of someone who says, hey, do you need help storing and moving your money? Great. I'm also going to use your money to fund my lending business. Tell them to go fish. Raising money is hard work. Real entrepreneurs, when they start a business and need capital, they have to create a spreadsheet, model their assumptions about how they intend to grow capital through revenue and expenses. They create a fancy slide deck, schedule hundreds of meetings with potential investors, then pound the pavement pitching until they find someone who shares their vision and their appetite for risk. Then quarter after quarter, they gotta produce numbers. Bigger numbers. That's a lot of hard work. Or, how about you go to OCC licensing and receive a government license to place a 4-letter word above your front door? Now you just get to sit back and wait for people to walk their money in and hand it to you. No spreadsheet, no pavement, no flashing bigger numbers. These folks are only showing up to store their cash and get a card from you. They don't have the tech. Isn't that convenient? Your lending company receives financing because people need help storing and moving their own money. You've just avoided a lot of hard work. So the word bank was given a definition by people who over-exercise their right to free speech. You want capital as a lending business? You pound that pavement like everyone else. And now seek the help of your government to uncompetitively traffic capital to you using a 4-letter word. 3. The money multiplier exports risk to the public by mixing promised with delivered value. What does that mean? Well, you walk into a bank, hand them your money, and in return they hand you a statement telling you your money's in the vault. Okay. But then someone else shows up to the bank and borrows that money. Fine. You lent the money to the bank, then the bank lent the money to someone else. But then, the bank receives government privilege to turn around and issue you another statement telling you your money's still in the vault. How would you like to borrow money from investors, spend it, then receive government privilege to turn around and tell your investors you still have the money you just spent? No other business in the world, besides a bank, has the right to spend money and then tell their investors the money is still there. Why would any firm receive this privilege? Now, an economist will tell you, that's fine, that's called the money multiplier. But a physicist will tell you, no, there's no such thing as the money multiplier. You're just double counting money's ownership. Money refers to something that happened in the past. Notes, which people sell banks when they borrow money, refers to an event expected in the future. And so banks are allowed to equate the notes they buy to the work people perform. Where people work, banks just expect. We call this mixing apples and oranges, or apples and promised apples. So what's called the money multiplier is just double counting money's ownership. Saying this without analogy now. On government authority, the bank has the right to tell the borrower and the depositor they both possess the object, serving as evidence that something happened in the past. Even though the note, which replaced the money in the vault, depends on an event expected in the future. Issue the privilege to spread this absurdity across the entire world, and everyone will end up on top of a bunch of promises. We've been here before, and we'd like to come back. Okay, 4. Monetary inflation. This is just a symptom of problem 3, or mixing promised with delivered value. Money's value is set by the goods and services it can purchase. That is, after the goods and services are produced. When you mix notes with money, a fraction of the goods and services you're expecting will likely not be produced. So now money can't buy as much, because your funny version of it includes chasing what banks expect, and not strictly what people have produced. 5. Central bank. A control mechanism for monetary inflation and avoiding collapse. Once you let people mix notes with money, you have to get real creative to mitigate the side effects. So you do stuff. But you have to call that stuff something sophisticated like monetary policy. When notes prove not to clear goods and services like money, prices climb. The monetary policy for this is dictate an increase in the price of lending for people who had no part in judging the value of the promises, purchasing them, or failing them. In other words, to slow down the effect of failed lending by a small group of people who received a government charter, keep the central planning train moving by dictating a decrease in everyone's credit score. That's who has to pay. And when a sinkhole of debt swallows an entire generation, the monetary policy is steal the purchasing power of producers by printing money, and then lend it directly to those responsible so they can devour the next generation. By the way, unless it's just increasing the denomination of the entire supply, like a stock split, printing money is never an option for any government. If you earn 1,000 by working, a central bank printing another 1,000 and handing it to someone else is saying that someone else performed half your work. You can call it a human rights violation, but this is no different than someone entering your home and stealing your property. People must go to jail for this. No immunity allowed. Anyway, at the end of the day, central banks are not the culprit. They're just run by folks trying to keep an economy afloat, while struggling with the words invented by charlatan academics, and as painful as it is to hear, a gullible republic that adopts them. People who need to entertain everyone with their conspiracy theories are also no help. Despite what spirited folks say about them, central banks are only formed because of something the Treasury does. which is issue people charters to mix the junk on their balance sheets with the public money supply. Privatize the balance sheets of banks and say goodbye to central banks. 6. Central banks manipulate the price of credit. Kept this one separate from the previous because of its catastrophic effect. Central banks request approval to print money from the Treasury. Once approved, they print. Then they push that fake money into the economy by buying bonds, which artificially lowers rates. That is, no one's lowered their risk through production. Now people are just borrowing money they can't afford to repay and donating that printed money to campaigns run by politicians who will approve printing even more money and handing it back to them. Now the market doesn't clear anymore. This parasitic activity between the host economy, the government, and its chartered financial industry sets underperforming assets from both above failure. And the bubble continues growing. Collapse. Don't need to say anything about this. History repeats itself plenty when people learn about it from television. 8. The government stops using the word deposits and starts using the word capital instead. Now everyone has to admit the money which was called deposits was used as capital to fund loans. Excuse, citizen, did you want to protect that money or invest it? Because you can't do both. Now your deposits are called capital, requiring control. Someone staring at this list may ask, hey, I see 8 problems. Why isn't it plural? The answer is, number 1 is the problem. The rest are just symptoms. In the next video, we'll eliminate the mystery of this equation and dispel a myth. Then, in the videos after, we'll present a physical solution to the problem by demoing the application and reviewing some code. You may subscribe, share, and contribute from the buttons and links in the description.